Companies' average interest-based lending, or assets that generate prohibited income like interest, should also not exceed 30% of its total assets.
Same logic, same threshold, just applied to assets generating interest instead of liabilities incurring it.
Precisely. And again, the standard is clear. Lending with interest is fundamentally prohibited. This 30% is a screening tolerance. And importantly, any actual profit earned from such interest. Well, that ties into a later control about purification.
Ah, okay, we'll get to purification. Is the average calculation the same here too, weighted by duration?
Yes, the principle is identical. It's a weighted average over the financial period, looking at the company's exposure to these types of assets over time.
And what kind of assets are we talking about here? What falls into this prohibited category for the 30% test?
Things like cash deposited in conventional bank accounts that earn interest, investments in conventional interest-bearing securities, think treasury bills, corporate bonds, money invested in conventional funds that themselves invest in interest-bearing instruments. Basically, any asset held primarily to generate interest income.
Okay. And the complexity with subsidiaries applies here too, I assume.
Yes, same principle. You'd need to look through to the holdings in subsidiaries proportionally.
All right, so we have the core business check. Then these two 30% financial ratio tests on borrowing and lending interest-earning assets. What if a company is okay on those but still gets some income from a non-compliant source? Maybe a tiny side business or some specific transaction.
Good question. That's where the fourth control comes in, the forbidden income control. This one looks at income from prohibited activities that aren't already captured by those main 30% asset tests, especially the incidental interest income.
So kind of a catch-all for other types of bad income.
Sort of, yeah. The rule here is that the income generated from these other non-compliant sources shouldn't exceed 10% of the company's total income.
10% this time, lower threshold. What kind of income are we talking about?
This could be revenue from, say, selling small amounts of prohibited goods like alcohol or pork, if it's not the main business, but still shows up in the revenue lines. It could be profits made from investing in the shares of other non-compliant companies. Income from certain financial contracts considered non-compliant, like maybe certain forward currency contracts. Even things like late fees or penalties charged on debt contracts, or rental income from a property if it's knowingly leased out for a prohibited purpose.
So it sweeps up various smaller streams of non-compliant revenue, capped at 10% of total income. Now, you mentioned purification earlier. What happens if a company does have some of this prohibited income? Maybe it's incidental interest below the 30% asset limit or this other stuff below the 10% income limit. As a shareholder, do I just ignore it?